This is the first of a three-part interview with Ian Niblock, who's the CEO and co-founder of Orca. One of the problems with the peer-to-peer industry in the UK is that it's very heterogeneous. In other words, there are many different types of peer-to-peer lending going on, some to business, some to retail, and some for mortgages. What this platform does is that it aggregates all of those under one umbrella so that you can choose which platforms you want to invest in, all with the same platform for a fee, of course. So what Ian's going to do in this first part is explain the why of Orca. In other words, what problem is it that it solves for investors?
Yeah, fantastic. Thanks very much for giving me the opportunity to speak with you today. It's great to participate in your show. We at Orca, we allow investors, so retail investors, to invest across the peer-to-peer lending market on our aggregation platform. We serve retail investors who are searching for yield. They understand that alternatives such peer-to-peer lending exist, but find it difficult to access the market, ultimately because, firstly, there's a large number of products in the market today, and secondly, investing occurs directly on individual platforms. So building a diversified portfolio across multiple lenders, multiple asset classes, a large number of borrowers is difficult, time-consuming and frustrating. So we've connected peer-to-peer lending platforms onto our aggregation platform, and investors can sign up deposit funds and invest across the market to earn returns, ultimately diversify their risk and save time because they're doing it from one platform.
So why is it that we need something like aggregation in this market? Couldn't people just work out how to do it on individual platforms? Or do you think that's an inefficient way of investing?
Yeah, it's a good question. So ultimately, individuals can go to underlying P2P platforms. So we find that there's two types of investors in the peer-to-peer market. There's investors that either choose one platform, say Zopa or RateSetter, and the deposit funds into that platform. The money is matched to borrowers, but ultimately the investor is exposed to the lending that platform does. And quite often it's quite niche parameters of lending, and also the financial stability of that platform. So we allow investors to diversify across the market very efficiently and easily. And the second type of investor is an enthusiastic peer-to-peer lender. There's quite a large number of them actually in the UK, and they're sometimes managing investments across 10, 15 peer-to-peer lending platforms. So quite a large number of platforms. They're logging in, on a daily basis, lending money and pulling down portfolio statistics on a spreadsheet, try to standardize the metrics, and ultimately work out how much money they're actually earning from their portfolio. So different platforms report slightly differently, and we also standardize that on our aggregation platform. So we provide, what's your portfolio performance doing?
Well, a lot of what I talk about with my clients is having a holistic view of your portfolio. So you don't just have your shares and your bonds and your peer-to-peer lending. You should think of it as one whole and somehow have things which sit well together. Almost like putting clothes on which match in terms of color, or kind of building a balanced meal. So how does peer-to-peer sit inside a portfolio? What role does it serve? Is it income? Is it capital growth?
So it's a really good question. I think it's dependent on the aspirations and ultimately quite often the age of the investor, so what they're trying to invest for. But what we would say with peer-to-peer lending is, it's not the place where you put all your savings, all your investment. It is a proportion of a well-balanced portfolio. We're talking 5-10% of a portfolio potentially allocated to peer-to-peer lending. And what does that do? Well, it's actually a very good diversification tool, because these loans, you're lending money directly to either individuals, businesses, or property developers. These loans aren't sitting on the market. So unlike an equity or a bond or a fund, these are non-correlated to traditional markets, and it provides a really good diversification tool for for investors. So say if we had another financial crisis, the impact of Lehman Brothers on equity markets, we wouldn't see that direct effect in peer-to-peer lending. So we believe, it's a really good way to diversify a portfolio, and it's a place for investors to either earn income or capital growth. We now have quite a large amount of data, so over 12 years worth of data, where the returns are fairly stable and predictable during stable economic climate.
What is the process by which you actually look at the individual types of peer-to-peer platform and lender and combine them? So what is the kind of culling process? What is it you look for when you construct a portfolio of peer-to-peer lenders?
It's a good question. I think that there's, you've got to look ultimately at the risks. So there's two principal risks within peer-to-peer lending. We believe in that's, platform risk. So whether the platform itself is financially sound, whether it's run by a good management team, whether it's susceptible to cybercrime or even fraud. So that's platform risk. And then the other one is credit risk. So the lending that the platform is doing, how likely is the borrower to pay back their loan effectively? Will they pay back their loan? And, you expect defaults, but, it's got to be stable and predictable. So we look at both sides of it. And also on the default risk, you also have more macro conditions as well. So it's affected by if it's a property lending, the property market. If it's consumer lending, what's the unemployment rates in the UK? If it's business lending, what's the insolvency rates? So to answer your question, to build a diversified portfolio, we believe that investors should be investing across all three lending sectors, which are principal in the UK, which is consumer lending, business lending, and property lending. We believe that investors should invest across multiple P2P platforms, and we believe that these P2P platforms should be vetted before investors deposit funds. And the type of things that we'd be vetting for are, how much lending is this platform actually done? Because you got to think a lot of these are relatively new businesses. Are they, well funded or in profit? And what's the performance of the lending to date been? So, and with that, we can curate portfolios on the behalf of investors.
Okay, that's interesting. One of the questions I often get asked is, what return expectations should I have? So for equity markets over like decades, 10, 20, 30 years, the expectation might be to get 6% nominal return, which means you don't count inflation. And if inflation is around 2%, which it usually is, then you'd expect about 4% long-term equity growth globally. So how does peer-to-peer sit in terms of that return expectation?
It's difficult to, the reason we have good analysis on equity markets is because they've been going around for a long time. So you have to think that peer-to-peer lending was created in the UK by Zopa, which was the first platform in 2005. So we have data going back to 2005. So in terms of returns, we have data on a nominal, I could pick a figure which would be between 5 to 7%, depending on the type of lending. But over a long period of time, including different economic cycles, we wouldn't have that data. But what we would say is, investors should expect in between 5 and 7%.
Well, 5 to 7% sounds really good, particularly given the very low interest rate environment in which we find ourselves. But what are the drawbacks? Well, you have to pay fees to Orca. So that's the topic of the next video.